Hi, I'm Pattu from freefincal. Today let's talk about a timing strategy for gilt mutual funds. Is it possible to time our exit and entry from gilt mutual funds for better returns? I had already made a previous video on this, an article on this. This is more of an update. I will soon be updating results of this timing strategy for other asset classes as well. Now, this is only for those who want to try and time the gilt segment. If you have long-term goals, I strongly recommend that you follow systematic investing in gilt mutual funds. But I want to show that it's possible to do the timing. Now, there are so many people who keep on saying you can't time the market and so on. To say that you can't time the market is factually false. It is like saying no one can climb Everest. If someone says no one can climb Mount Everest, it's basically they are lying. But if someone says it's extremely difficult to climb Mount Everest, don't try it, it's not for everyone, that's fine. That's reasonable, sane advice. But that doesn't mean you can, just because something is hard to do, doesn't mean you can extrapolate it and say it's impossible to do. So it's incorrect to say you can't time the market. Yes, I agree that no market timing strategy will work all the time. No market timing strategy will work for all asset allocation combinations, for all asset classes, etc., etc. We have a long disclaimer for that in the post and in our tactical strategy tool that comes with it. But the point is that it's possible, and those who want to do it can try it, and those who don't want to do it, that's fine. You can always use systematic investing. It's a matter of choice, but factually it should be understood that is possible. Of course, there are behavioral things that come into it, taxes that come into it, exit loads that come into it. That's all fine. There are practical problems with it, but that doesn't mean you can wash away this the fact that you can time the market. That's the point I want to make. All right, so let's get straight to it. I have a long disclaimer with this, and I have shown a market timing strategy for gold, for equity, etc., etc. I have also shown different types of tactical asset allocation strategies. You can there's this entire section on freefincal about this. You can have a look at that as well. So the first thing I want to talk about is that if you look at the gilt index, that's a red line. That's not it's not sensitive to what happens in the market as much as the yield. What you see in the blue line is the inverse of the 10-year bond yield. So the 10-year inverse of the yield is basically the PE. So it's the bond PE. So that is quite sensitive to what happens in the market, movements in the market, supply demand forces in the market. So we will be using the bond PE instead of the price. Instead of calculating the moving average on the price itself, which is the red line, we will use the bond PE and calculate the moving average on that. So what you see here is the blue line is the 10-year bond PE, the red line is the 12-month moving average, the green line is the 6-month moving average, and based on this there is a simple buy and sell signal that's based on these two models. I'll explain. And that's how the strategy is developed. So there are two methods we use. One is we buy a gilt fund when the bond PE is greater than both the 6-month moving average and the 12-month moving average. We sell the gilt funds and move to cash if the bond PE is less than both moving averages. That's the first method. And the second method is just to use one moving average, which is just the 6-month moving average. Buy gilt when the bond PE is greater than the 6-month moving average, sell gilt funds when the bond PE is less than the 6-month moving average. So it's basically a momentum kind of strategy. So let's get to the results. And so what we will do is basically consider the IBEX gilt index, and we will consider every 5-year, 10-year, 15-year durations between May 1998 and May 2022. And please recognize that everything will change if I change the index, if I change the P, if I choose some other yield, some other duration yield, everything can change. The asset allocation, everything will change. So we will have, in this case, there is no asset allocation. In this case, the systematic approach means buying 100% only gilt funds. Tactical approach means whenever there is a buy signal, you buy 100% gilt. Whenever there is a sell signal, you buy 100% cash, and you also exit your previous holdings on gilt. Also, I want to caution you that this study does not take into account taxes and exit loads, because taxes keep changing. I have done this over 1998 to 2002, 2022. Things keep changing, so you can't take into account all those and make a factual accounting of taxes and exit loads. But you can look at the results, and you can if you want, you can reduce the returns by 1%, 2% and so on, and then you can judge for yourself. So it's not such a difficult issue to take into account taxes, just that you must understand that they have been left out of the study, and you must take that into account later. So we will first we have the 5-year data, and you can see here the tactical results. We have about, let me just go back to this. Over 5 years, we have about 231 back tests, and you can see that over the 231 back tests, typically the XIRR of the tactical strategy is better than the systematic strategy. Then you have the maximum drawdown. The maximum drawdown is the fall from the maximum. So here lesser is better. So sometimes the tactical strategy does better, but not always. Then you have the volatility of the portfolio. Generally, the tactical strategy has a slightly lower volatility. Then you have the number of months the portfolio has been continuously underwater. That is, it falls from a peak, and then how long does it stay continuously below that peak? Again, here lower is better. Sometimes the tactical strategy does better, but not always. Over 10 years, again, you have the XIRR gap between the systematic and the tactical widening. The tactical strategy is a little bit better than the systematic over 10 years. Over 15 years, again, it's a slightly better, and you have a much more clear gap. But in terms of risk management, I don't think this tactical strategy is much of a risk management tool, except other than the maximum drawdown being slightly less for some times. I don't think you should count on this tactical strategy to reduce the risk in your investment, but it is a momentum based, slightly aggressive strategy, and typically it can give you, there's a chance of it getting a higher return. It will not work all the time. Just because the backtests show that it has worked all the time doesn't mean after you start investing it will work for you, because you will be investing in a gilt fund which will be different from this. You may be using a different gilt yield and so on. There are so many variations possible. So the backtest tells you that it is possible to time your entry and exit into gilt funds. That's all. Whether it will work for you in future or not, no one can give you such guarantee. That's a chance that you will have to take, and that is the reason why I keep saying people are better off with a systematic strategy. Of course, I have also shown results for the other model, that is using the 6-month moving average also. Those results are slightly better than the double moving average. The XIRR difference between tactical and systematic is slightly higher in the 6-month moving average alone. The only catch is the number of times you have to buy and sell is slightly higher when you use the 6-month moving average alone. For example, over 5-year period, the average buy and sell times is about 4. It's about 3 in the case of 2 moving averages. Over 10 years, you have to buy and sell at least once. So that means the higher the number of times you buy and sell, more will be the tax incurred, the exit load incurred, and so on. In the case of, if you use 2 moving averages, 6-month and 12-month, the number of buy and selling is lower than the single strategy, that is the single 6-month moving average strategy. Although the 6-month moving average strategy is slightly more rewarding, the taxation will hurt it. So you have to have some kind of compromise, and I will say use the double moving average. It's slightly better. So I have the data for the 6-month as well. You can for 5 years, 10 years and 15 years, you can have a look at it in the article. Again, I want to point out to viewers that no strategy will work at all times and all markets and for all asset allocations. Here there's no asset allocation, but if you were to use equity and debt, then there is an asset allocation that comes in. You must understand that you can find a method that works well, but that doesn't mean when you start investing for your particular sequence of return, it will work. Nobody can guarantee that. So you have to take these caveats into account and understand that timing the market is possible, but it's rather difficult, and in terms of behavioral control, in terms of taxes, and also there is no guarantee that it will work. Of course, that's the same as the past performance disclaimer. Just like a mutual fund has got past performance disclaimer, just like an SIP has got a past performance disclaimer, the tactical strategy also has a past performance disclaimer, and that should be kept in mind.